Gamma is a measure of the rate of change in the delta of an option, which is a financial derivative that gives the holder the right, but not the obligation, to buy or sell a specific asset at a predetermined price on or before a specific date. In the stock market, options are used as a way to hedge risk, generate income, or speculate on the direction of a stock's price. Delta is a measure of the sensitivity of an option's price to changes in the price of the underlying stock. It is expressed as a number between 0 and 1 for call options, options that give the holder the right to buy the underlying stock, and -1 and 0 for put options, options that give the holder the right to sell the underlying stock. A call option with a delta of 0.5, for example, would be expected to increase in value by 50 cents for every $1 increase in the price of the underlying stock. Gamma, on the other hand, measures the rate of change in the delta of an option. It is expressed as a percentage and represents the amount by which the delta of an option is expected to change for every $1 change in the price of the underlying stock. For example, an option with a gamma of 0.1 would be expected to have its delta increase by 0.1 for every $1 increase in the price of the underlying stock. Gamma is an important consideration for options traders because it can affect the profitability of a trade and the risk profile of a position. A high gamma means that the delta of an option will change significantly as the price of the underlying stock moves, which can lead to large profits or losses. A low gamma, on the other hand, means that the delta of an option will change only slightly as the price of the underlying stock moves, which can make a position more stable but also potentially less profitable. There are a number of factors that can impact the gamma of an option, including the price of the underlying stock, the time until the option expires, and the volatility of the underlying stock. When evaluating an option position, it is important to consider the gamma along with the other Greeks, which are statistical measures used to assess the risk and potential return of an option position. Some of the other important Greeks include theta, which measures the time decay of an option, and vega, which measures the sensitivity of an option's price to changes in the volatility of the underlying stock. Overall, gamma is an important concept for options traders to understand because it can impact the profitability and risk profile of a trade. Whether you are a trader looking to profit from price movements in the underlying stock or an options seller looking to generate income through the sale of options, understanding gamma and how it impacts your positions can help you make more informed investment decisions. If you enjoy our content, don't forget to like the video and subscribe to stay up to date with market news. Thanks for watching, and stay informed.